Hello, guys. Welcome to Finance Magnets Africa Summit here in Johannesburg. We're obviously live from the Scope Markets booth here at the show, where it's incredibly busy. Loads of traders here gathering, speaking to each other, looking at all of the different exhibitors. So it's a fantastic atmosphere here so far at the trade show. We're on day one. After yesterday's networking blitz, this is day one. We'll be on a panel live later this afternoon. We've got more content coming from within here, which is our amazing stand at the show. But right now, we're going to have a quick, brief chat around some of the markets. I'm here with Josh Mahony, who is Scope Markets chief market analyst, and we're going to talk, around some general markets and just how markets are moving at the moment. And I think probably the best thing to start off with, Josh, you're the man with the expertise in these areas. I mean, let's kind of start off with a bit of what's the current state of the market at the moment, and that's a very broad topic of that. What's the state of the market? But how are things looking from a general market and a trader's perspective? I think.
Yeah. I mean, look, this is a really interesting time, and I think from a trader's perspective, it can be quite difficult to understand exactly why markets are moving in a certain way. For instance, you're seeing the likes of the US jobs report coming out strong. People don't necessarily know whether that's good news or bad news at the moment. We've seen equity markets moving upwards, but of course that's in a framework where we're in a year where everyone was thinking we're going to see a recession. In actual fact, the economy is doing particularly well. Yeah. Then you see this banking crisis suddenly coming around, and people think, is this 2008? Are we going to see a massive crash? That hasn't necessarily happened yet, but it's certainly something that keeps ticking along. But it does feel like we've reached a point where there could be some sort of turn in the horizon. Yeah. And that brings the possibility of volatility. And that's because the way that markets have been pricing interest rate movements has been around, okay, soon enough we're going to see central banks flatline in terms of interest rates, and that will likely happen. They can't raise interest rates forevermore. But
we'll all be pleased to hear that, I think.
Yes, and 4.5%, 5%, okay, great, but is that going to do enough to drive down inflation towards target? Well, if you ask someone over in England, I don't think that's going to be enough. We're still in double digits here over in England. So
so what are we, 10.1%?
10.1, yeah.
Yeah, 10.1%, and we've had how many? 5 rate hikes,
well,
maybe it is?
Yeah. Is it going to be enough? I mean, what's the Bank of England going to have to do? And how long are they going to have to raise rates for? That's the question mark, because markets have been pricing in this idea that they're going to see rate cuts within a year. Yeah. Well, 10.1% in the UK doesn't really sound like they're going to be looking for a rate cut anytime soon. And especially with the economy doing so well, the UK was supposed to be in recession. Certainly you could say 0.1% on the GDP reading isn't so well, but it's not recession.
No, exactly. It's not what was expected.
So we're outperforming on that front. And we've got inflation as high as it is. And so we're looking at a position where the central banks essentially are being told, you can push it a bit further. And in my mind, there's a risk here that they're essentially going to have to break the economy to try and actually drive down that inflation, because the consumer is relatively strong. The consumer's essentially saying, well, give me a decent pay rise and then I can continue to go out and pay double for a coffee.
It's the wage rising, which is the thing that's been interesting, not just in the UK. You take this in the US as well, right? So wage rises have been particularly strong. We're looking at the payroll numbers this week. Wage numbers were not massively great, but they're still there. But I think what's interesting when we look at the Fed this week or last week was that it was kind of touted that was the last rate hike, until Powell started speaking and kind of said, well, maybe this isn't. It could have another rate hike.
That's going to be the theme.
Yeah.
That's going to be the theme.
Yeah, that's kind of the question. I think, is it a situation where we go, every time we get to it, the market will go, oh, this is the last time, guys. Don't worry, this is the last time. But then Powell, Christine Lagarde, Andrew Bailey, someone will say, well, just hang on.
Last week was particularly important for that because the RBA did exactly that, right? Everyone thought the RBA were done. And then all of a sudden they come out and say, well, actually, here's another rate hike your way, and we could do some more around the corner. And so I think it's going to be an ongoing theme. And so when we're talking about equity markets that have now started to flatline, start to roll over a little bit, I think we're moving into a position where people are starting to realize that, okay, we were talking about the terminal rate being 4.5%, 5%, and now all of a sudden we're looking at central bankers that are saying, well, actually, we might need to do a little bit more because inflation is sticky, because the core number's not necessarily rolling over like the headline number is. And certainly in the UK, we're barely seeing the headline number even roll over in a meaningful way. So I think that is the big threat to markets. The banking crisis is something. We've got the debt ceiling coming around at the moment as well. So June 1st, we've seen it all before, quite frankly. It's a soap opera that's played out many a time if you follow the markets.
Yeah, I mean, let's probably look at this banking crisis for a little while, because I think there's that interesting point, isn't there, around everybody will say, and we saw obviously what we've seen 2 banks go, but the headline in this banking crisis, of course, Credit Suisse, right? So Credit Suisse out of business, bought up by, can't remember, JP Morgan, was it? Or someone, can't remember anyway. the key thing here is everybody's saying, is this 2008 again? It's not that sort of crisis, is it? It's not that entrenched. Obviously, it's completely different reasons, but the issues are not that entrenched into the banking world.
I'll tell you what I find interesting by this whole thing. That is, predominantly it's the smaller banks, right? So we've just seen PacWest, another smaller bank, essentially coming out and saying it's kind of up for sale because it needs liquidity, so it needs someone to come in. And I think we're going to see more of that. The problem here, and the Federal Reserve really alluded to it when they came out with their latest rate decision, is that they raised rates too quickly. But then at the same time, they didn't really have that much of a choice, right? We've seen it across the board. And all of these positions that these different banks are holding, that they're now having to essentially announce, okay, we've got significant losses on our bond positions. That's something we're probably going to hear more about, and the only way to really resolve that is for central banks to cut interest rates. So there is a need for central banks to reverse course, and that really does highlight. I don't think they're going to do that now. I think they're going to, more than likely, we're going to see more smaller banks being gobbled up by bigger banks.
Yeah.
But I do think that there is a theme that central banks will want to cut rates as quickly as possible, and that comes down to inflation. So what we're looking at here is to some extent a rather predictable move. I think that at the moment we're too optimistic. Once markets start to see that it's going to take longer for inflation to come back down towards target, for central banks to then be comfortable in a position that they move towards rate cuts, that's going to be longer. So I think we could see some weakness, and therefore you see a move back into risk havens. So we're seeing likes the US dollar, the Swiss franc, to some extent the Japanese yen will come back into a bit of strength.
Sure.
But then the back end of that is we're going to end all of this with rate cuts. And therefore, you're going to look towards risk assets. You're going to see that the likes of the NASDAQ probably leading the way higher throughout that period. And for me, precious metals, I think, are going to be a big outperformer over that period. Generally, when you see rate cuts, you see precious metals do well. So that's going to be something to be looking out for.
I think that's the interesting point. And I think talking about gold, obviously, we're here at the trade show here. We're showcasing exactly what Scope Markets offers. We've got, indices, currencies, precious metals, commodities, stocks. Obviously, you can trade all of those things through Scope Markets, but let's focus on those precious metals just for a second and say the gold price has obviously been it always seems to be a crazy situation with gold. We're either sitting there watching it hit all-time highs continuously, or there's some other ramification which is driving gold higher. I mean, what do you think's the outlook for gold at the moment? And I think probably gold and then some of those other currency areas that tie into that. But I think precious metals in general, we see a lot of flow from our clients around gold. So just understanding where that's going, I think, is one of those key things.
And that's an interesting thing. Obviously we're in South Africa at the moment, and the rand is closely correlated with the price of gold. Something that here at Scope Markets we've noticed is that clients love to trade gold. And personally, for me, it's one of the key markets to be looking out for in all this. Bear in mind that, of course, the likes of Russia and China would like to change this, but gold is generally traded in the US dollar. So you're going to be looking for the trajectory of the US dollar to determine exactly where gold is going. And therefore, when I'm talking about the idea that I think we could move into a risk-off environment for a period of time, a number of months, I think that would likely see gold actually drag somewhat. But I think that would push us into a period where we're going to see people coming back into risk assets, the US dollar weakening, equity market strengthening. I think despite the fact that people say, oh, gold is a haven, I don't see it that way. I think
that's a bit of an old-fashioned view these days, isn't it?
I don't think it's certainly not been shown to play out like that recently. So I think that gold actually is going to do particularly well at the time when the equity markets are rallying, the US dollar's coming off. And so I think, for maybe 3 months, 6 months down the line, that's when we're probably going to start seeing that next big bull run coming for gold. And by proxy, silver. Generally, silver outperforms at times when gold's doing well, but it underperforms when gold's doing poorly. So generally, it's just the sort of more volatile sort of brother or sister.
Yeah, exactly right. Yeah, so, I mean, the silver situation is interesting as well. But, I mean, I know gold from that perspective. Let's kind of shift it over to and you obviously mentioned Russia, Ukraine, the issues that we have there. Of course, oil prices have had such an enormous effect on the cost of living crisis, the reason inflation is so high, and fundamentally where we are with the central banks and the rates. That outlook for oil is really interesting because oil is actually really low. You know, it's come. I mean, recently, okay, there's been some other moves. It's relatively low compared to where we were, obviously, at the start of the war between Russia and Ukraine. But yet, we still talk about high energy prices, high gas prices. But obviously, that's from a exactly. I mean, the outlook in this area is key. Yeah, so the outlook in this area, this energy area, is a key one for traders. And from a trading perspective, obviously, we can look at there's a lot of opportunities there, right?
Yeah, I mean, look, ultimately, you can talk about all you want and say that gold is the thing that you want to trade, but the fact of the matter is that energy is going to be the driver of everything. Because if you saw a big pop in energy prices, what's that going to do in terms of risk attitudes? Because that has a massive knock-on implication in terms of inflation expectations. And if we suddenly start thinking that we're going to see a second pop in terms of inflation and this big push to try and drive inflation back down to 6%, 5%, and suddenly it gets back up to 8% or something like that, that's going to be a huge thing for markets. I think energy is going to be a key thing going forward because we're actually trying to move away from fossil fuels, and it means that people are underinvesting in it. And so when you see that underinvestment, in particular over in the US, which has been previously the biggest producer in the world, you know, then you're seeing less supply. We still have the demand there. So there's the possibility for that supply-demand dynamic to shift energy prices up towards the upside once again and cause a big problem. Yeah. Certainly, the number to be looking out for me is $70. Bear in mind that over in the US, they've been drawing down on their SPR, so their Strategic Petroleum Reserves, but they've said that they'll start topping it up around that $70 mark. And so if they turn from a net supplier to market and all of a sudden have to start refilling this huge amount of reserves that they've essentially drawn out, then that again shifts the dynamic once again towards higher energy prices.
Yeah, sure. And I think obviously we've seen, there's 2 points here I want to make. Obviously there's one area around China, obviously, and the output levels from China, you know, the demand issues in China. They're one key thing. But obviously I want to come back around a little bit and talk about the earnings side. You know, we've seen oil prices and these big energy companies. That is a hot topic for everyone. Everybody hates to talk about a multi-billion-dollar quarter for an energy company. But from an earnings perspective, it kind of just ties into the earnings picture in general. You know, we are seeing pretty decent earnings from these companies.
Yeah, I mean, actually, I would say energy is one of the underperformers over this one, partly down to expectations, because I think we've gone through this period where they've been having such bumper profits that for them to be able to try and keep up with that when they were making these profits at $100 a barrel, $110 a barrel, it's always going to be very difficult for them to be able to maintain those kind of levels of profit. So it's always going to be this correlation between energy prices and the profits that you're getting for these companies. But the margins are so massive that they're always going to turn huge profits, huge earnings. It's just when you're looking on a relative basis, on a year-on-year basis and the like, then you could see them and say, oh, well, they're underperforming. They're still making huge amounts of money.
Yeah,
you know,
exactly.
And certainly when we're looking at the earnings numbers, I would say the one area that everyone needs to be focusing on is tech, because when you're looking at equity markets over in the US, they're essentially driven by like 7 names.
Yeah,
because they're
so talking big FANG stocks,
exactly,
right? You know,
so where the FANG stocks go, the rest of the market goes. You could see an equity market where pretty much, you know, I don't know, 490 of the S&P 500 could be not doing that great, but the remaining 10 are doing so well that the market looks like it's doing great. Yeah, exactly. So as long as those tech stocks are still holding up, then great. But that breadth issue could become an issue, because if we see those tech stocks start to roll over, then all of a sudden the fact that it's all being underpinned by their strength becomes a problem. Fortunately, a lot of them have done particularly well and really outperformed over the course of this earnings season. So that does really build the basis for people to start thinking, oh, great, I've always wanted to get Amazon shares. I've always wanted to get, you know, Meta shares, but they've always been very expensive. Maybe this is a time to start buying the dip.
And that's the problem with not the problem, of course, from a trader's perspective, this is fine, but whenever it's very hard to see those FANG stocks. I know we took FANG, I know one's called Meta, one's called Alphabet. You know, Tesla you've got to have in there as well these days, but when these stocks drop a little bit, it's never sustained, because everybody goes, oh, I've been dying to get into these stocks. I'll just use this dip to buy in. Doesn't matter what the outlook is for these guys. We've seen the likes of Apple not perform as well as they have done. A lot of the forecasts have not been great. Look at Netflix; their forecasting has been awful for pretty much ever. You know, their forecasting has never been particularly good. Yet every dip results in huge buying.
Yeah, and let me tell you, if you look back through COVID, you look at companies around the world. What were they doing? They were all hunkering down, trying to cut costs. Who wasn't? It was the tech sector.
Yeah.
They went crazy because they were doing so well. Everyone was sitting at home ordering every item off of Amazon instead of going down the high street, right? So this recent episode has actually been particularly good for tech stocks because it's meant that they finally sort of cut the wheat from the chaff and really started to streamline a little bit that they didn't necessarily do previously. So they're going to be a lot more streamlined, a lot more efficient. They're going to be more profitable. Certainly Salesforce, I think, is a really interesting one because it's always been the case of like, just expand. It's all about revenues. And now all of a sudden we've seen Mark Benioff coming out and saying, oh, it's all about profits now. And so that really means that they're starting to take into account the cost side of thing, and that's something that they haven't necessarily done so much of previously. So we have seen this episode as being particularly good for tech. I think if you look in terms of the cycles within markets, growth stock, tech stocks, they always lead the way. So when we see the exit out of this phase and suddenly everyone's feeling great and we're seeing sort of interest rates being cut, risk on moves, equity markets, I think, are going to be heavily geared towards the NASDAQ and tech stocks and the like. So I think the long term, they are going to be good, and that's why people are buying into them now.
Sure. Yeah, I mean, just to round us off here and kind of finish off, obviously we're here a couple of days this week. We're going to be live again a little bit later on, I think, at some point, and definitely tomorrow. What's the big focus this week, you know, from a market perspective? You know, there's a lot of data coming out. It's always interesting, isn't it, after a rate hike week, you had ECB, RBA, and the Fed last week. What's the big focus this week that you're keeping an eye on for Scope clients?
We've got the Bank of England coming up, but I would say it's got to be US inflation. That's going to be coming tomorrow, so we've made it. So we're doing 4 hits over the course of this, so make sure to tune into our channel. But we're going to be having one afterwards, so we'll be able to talk about exactly what that has told us, what's changed. You know, there's always a lot of underlying information that some people don't necessarily have the ability to pick through.
Brush over it.
So we'll be able to look through it and see exactly what has changed and what that has in terms of implications for markets. But look, ultimately, what happens in inflation changes everything, changes the dynamic for every single market that's out there. And so US inflation, that is the key thing. This week, CPI, PPI coming out later in the week. So that's what I'm going to be keeping an eye out for. And of course, we talked about that 10.1 inflation rate over in the UK. So the fact that we've got the Bank of England coming out and people think this could be the last rate hike. We're both sceptical on that front by the sounds of it. So,
I don't want to be sceptical, but I very much am. Okay, brilliant. I mean,
keep an eye out for that.
As Josh says, we'll be talking about this, you know, over the next couple of days. We'll be live tomorrow, directly after the US CPI data, so we'll be able to get you live reaction to that. But I think we're here this week. We're here the next couple of days in Johannesburg at the show. If you're in South Africa, if you're in Johannesburg and you're registered for the show, come down. You can't miss us. We are, as you walk in the door, booth number 1. But I think, Josh, thank you for that. We'll speak to everyone else at another time, but that's it for this session. We'll be live again later on today, live twice more tomorrow. But apart from that, thank you for watching, and we'll see you again soon. Thank you.
Thank you.
Hello guys, we're back at the Finance Magnets Africa Summit here in Johannesburg, and I'm back with Josh Mahony, who's Scope Markets Chief Market Analyst. My name's James Hughes. I am Group Head of Marketing here at Scope Markets. This time we're focusing a bit more. Earlier on we spoke a bit about, markets, what's moving, what's not. This time we're going to look a bit more at risk, what are those key things that traders are looking at the moment, which are, the riskier side? What's risk on? What's risk off? And how can clients really protect against it? I suppose is what we're looking at here.
Yeah, I mean, I guess your definition of risk is always going to be quite interesting because for someone that is looking at things because they're just holding a bunch of stocks, what's the risk that the market could sell off? Well, there is a significant risk because we're talking about debt ceilings. We're talking about the possibility that markets might start repricing a longer period of time in terms of interest rates being elevated and the economy potentially taking a significant downturn. You're talking about the banking crisis. Could that take a turn? So those are risks for people that are holding assets that could devalue. But of course, from a trading perspective, you can trade both sides of the coin, right? So a risk of a market sell-off is also a potential opportunity and a potential for volatility that people can take advantage of. Certainly, there's the risk of higher volatility, and that means that people should always take steps to mitigate the possibility that then goes heavily against them. And that is certainly something that if you're looking from a sort of newbie's perspective, someone that's just getting into trading, you need to be able to mitigate your losses. That is the number one thing that's going to be able to keep you in the game, is making sure that your losses are minimized. If you have one really bad loss, then that can undo everything great you've been doing for the previous 10 trades.
Yeah, I think this is key, isn't it? This is one of the key areas that a lot of people focus on, and we've both been doing this kind of job for a long time. We both taught clients how to trade. We've given seminars around things, and we always have that section in a seminar. Maybe compliance stick it in, but we have that section in a seminar which is about risk management, and we always highlight the importance of stop loss. You tend to get people kind of switch off at that point. They go, it's the risk management bit, we don't really need that bit. It is so paramount to trading for a long time, You trade without those stop losses, you're in trouble, You're causing yourself issues, and you're making your shelf life very short in trading.
Yeah, and the interesting thing, excuse you, the interesting thing that I think you'll find is that when you're a newbie trader, right, the thing that you're interested in is absolutely cornering the market, right? I'm going to call the top, I'm going to call the bottom, I'm going to ride it absolutely perfectly. And as soon as someone starts talking to you about risk, you start thinking, this is the boring bit that I'm going to switch off on. The interesting thing, and I speak from experience because like you said, I've spoken of these topics on a number of occasions to high net worth individuals. Those are the people that have a lot more attention to that kind of detail, because over time, the ability to preserve capital is going to be absolutely key to being profitable over the long term. And look, I can give you a strategy, a financial trading strategy that I can tell you will make you profit, will be profitable. But if you're not actually able to have the right mindset and have the right risk controls in play, you'll still lose money. Conversely, if you give a trading strategy that doesn't necessarily work, isn't a great trading strategy, to someone that's got particularly good control over their risk and their psychological side of it, they'll be able to take that strategy, improve it, and certainly they'll probably last longer than the person with the good trading strategy because they're not taking these crazy risks and risking a portion of their account that's so big that when things go against you, and bear in mind, you will take losses. When it goes against you, you need to be able to live another day. So look at the percentage of your account that you're risking. That's how you should be allocating trades. That's how you should be position sizing. So maybe 2% of your portfolio per trade as a potential loss size, because that allows you to stay in the game. If you're risking 10% of your account each time, then soon enough you're going to be 50% down on your account, and suddenly you've got to make 100% to get back to where you were before.
Yeah, totally.
Then the mental side of it takes over. You start freaking, you start taking trades that aren't the right trades.
Yeah, those panic trades that get you more in trouble.
Exactly, and soon enough you're back down to zero. So really, the risk approach to it is really key. To the upside, you can have, don't necessarily have to limit it so much. The take profit, isn't as important as the stop loss. The stop loss is key here.
Yeah.
You know,
Yeah,
so
exactly. And I think one of the things I've always said previously is that, you know, the traders that are successful are the ones that learn how to lose money. Because you will, at some point, you know, unfortunately, shock horror, guys, you know, major newsflash. At some point, one of your trades will lose money. You know, no one ever trades and it's win-win. P&L curve like this doesn't happen. You know, so at one point you're going to lose money, but it's those who understand that. Number one, understand that you're going to do that. Number two, do it well. In which case, I mean, have placed suitable stop losses. They have risk management tools in place, and those things have kept them afloat. Basically, you've lost money. You were wrong in your trading decision, and again, it's about accepting the fact that you can be wrong. Exactly. You can be wrong. Don't flog it to death. If it's going down and you're wrong and it's gone through your levels, one of the key things, and this is something that I'm sure we've both come across a million times, is that, and we've probably both done it, you know, when you're in a trade, that trade's losing. You've got a stop loss in place, but it's getting down there and you're...
This trade's going to be right
this
in the end.
I'm just going to drop this stop loss by 10 pips, 15 pips, and then it comes down 8 and you're like, I'm just going to do it a little bit more, you know, and you move that stop loss and then eventually you're out. You know, you've gone anyway. And you've lost more money than what you realised.
And when you set that trade in the first place, you have an associated risk to reward profile with that trade
Yeah.
based on the distance of that stop loss. As soon as you keep moving that, all of your risk to rewards are completely out the window if you're doing that with each trade.
And the crazy thing is here, right? So you do this strategy and you think about your trading strategy. Before you place any trades, you think about your trading strategy. You understand this is my risk to reward ratio, this is where I am, and you're thinking, you're level-headed when you're planning your risk strategy and you're planning your trades. However, when you're in the trade, you're thinking crazy, and then you think it's the best time to make your decisions about it. Totally wrong.
There's ways to get around this. You know, there's ways to get around this. Don't spend all your time staring at your trades. Set and forget is one way to deal with it. You know, place your trade, don't look at it again. It either hits your take profit or it hits your stop loss. Ultimately, you put your stop loss there for a reason. That's the point at which your trade is invalidated. If it hits it, you live another day, you've taken a small loss, and you're then on to the next trade. You know, it's when you let those losses run that you really get in big trouble. But like we're saying, sort of rounding it back to the beginning, there's risks within the markets at the moment, but that can be an opportunity for people. If you're seeing those big moves, potentially towards the downside, if that's how it plays out for equities, you know, that would be to the benefit of the dollar most likely. You know, that can be towards the upside. That can be where your take profit can be, you know, further away and you can make 2, 3, 4, 5 to 1 risk to reward profile. But certainly be aware of where your stop losses should be placed and don't necessarily keep moving them around. You know, if you're wrong, and move on to the next trade.
100%, 100%. I mean, I think that sounds like a pretty good place to leave it, to be perfectly honest. You know, we covered off quite a lot of these key points. I think probably what we could take from this are stop losses are important.
Place your stops.
Place your stops, guys. Place them. You know, they're important.
Don't get
We've all
married
heard
to-
this before. You know,
Don't get married to your trade, but do get married to your stop loss.
what a line, this guy. Apart from that, guys, thank you very much for watching. And again, just to let you know, as tomorrow we'll be live again. We'll be live just after the US CPI data. We'll be live a couple of times tomorrow. Again, more data, more information to cover. But until then, thanks for joining us, and we'll speak to you soon. Thank you.